Hey, what's going on? And welcome to another episode of Garrett the Investor. Thanks so much for watching. Okay, I think we can both agree that real success takes time, especially as it relates to the stock market. However, there are ways to reduce the time it takes to reach your financial goals by learning proven investment strategies that are used by some of the most successful investors like Warren Buffett, Ray Dalio, and Carl Icahn. I mean, think about it. If you wanted to learn how to play guitar, you're better off learning from guys like Jimi Hendrix, and Eddie Van Halen rather than your elementary school music teacher. Now, when I first got into the stock market, it was really intimidating based on all the information that is available on this topic. So the goal of this channel in really this video is to give a breakdown of the most effective investment styles and strategies so that you're more equipped to invest with confidence and reach your financial goals more quickly. Now, there are many different investing styles and strategies, just like there are many different types of and genres of music. Now, when you look at the different, in contemporary music, it really boils down to 4 or 5 different instruments. You've got your, guitar, bass, drums, keyboards, and vocals. However, the techniques that are being used to play those different instruments creates all these different genres and sounds and results. The same thing goes for investing. So the key in this video is to understand the different types of investment styles and strategies and kind of blend them into whatever you gravitate towards the most. It could be one style, it could be one strategy, but really kind of blending it into what you perceive as your own personal style going forward and being consistent in that. Now, when you look at investing styles, there's really breaks down to 2 different investing styles. You've got passive investors and you've got active investors. Now, the passive investors really take the approach of, the stock, or, diversifying their portfolio and kind of mimicking the Dow Jones or the S&P 500. They also believe that all of the stock price is the accumulation of all available information. Therefore, any time to buy a stock is a good time, and that as long as you hold long term, that your investment and your overall portfolio will increase with that. Now, active investors, on the other hand, they believe that the stock's price will really differ from the intrinsic value or their actual price it should be. And what kind of comes to my mind when thinking about intrinsic value or fair market value is Kelley Blue Book. When you go out to, and maybe you haven't done this before, but when looking out to buy a car, especially if it's a used car, you always want to look at the Kelley Blue Book value to figure out what is the market price, like what is it being sold at out there in the market, what's being purchased at. And that kind of gives you a good idea or the intrinsic value of what that car should be. That way you don't get ripped off at the dealership. Okay, so they also believe by doing this, it creates more buying and selling opportunities to get larger returns and ultimately beat the stock market. And then they take advantage of the irrationality of the stock market and take advantage of the cognitive biases and emotions that can bring the stock price higher or lower than its intrinsic value, which is kind of dictating their decisions. Now, here's an example when buying. Their approach is obviously different between the passive and active investor, but say they both want to buy into Apple. The passive investor approach, they might buy Apple at its current price, whereas the active investor might take a look at the intrinsic value and calculate it to be $280 versus the $316 or $18 price that it currently is at. Therefore, the active investor might wait until the price drops to their buy level before entering a position into the stock. If the active investor is correct, they will be able to earn a higher return on their investment over the same amount of time. However, if the stock never falls to that buy level, they might be missing out on a very large opportunity and might be having to buy into it at a higher price if the stock price continues to go up. Now, the approach when selling, similarly, the passive investor may set a specific time to sell a stock, like for retirement or for a down payment on a home, whereas the active investor may sell a stock when there is a rational spike in the price of a stock and be able to take the profits before the stock goes through a correction or balancing, which it tends to do. However, the active investor runs the risk of cutting profits too soon, and the stock might increase even more as time goes on, which we're seeing in this example. Now, there's pros and cons of each strategy. And really the pros of passive investors are that it's less expensive and not time consuming. Now, the cons of this is that it's heavily correlated to the markets, so that it leaves more exposure and vulnerabilities during times of economic downturns, which can be emotionally discouraging. Now, active investors, on the other hand, the pro of being an active investor is that you can use hedging techniques during market downturns. An example of this would be buying into Johnson & Johnson and Clorox, knowing that these stocks will more than likely go up during the COVID times that we currently live in. Now, this can enable you to outperform the market during economic downturns. Now, the cons of active investing is it's time consuming and can be expensive depending on the brokerage form that you use. Now, each style offers its own strengths and weaknesses, strengths in different economic periods. So incorporating both of them during different market cycles could be beneficial. For example, passive investors tend to outperform active investors in periods of low volatility, whereas active investment styles tend to outperform the market during periods of high volatility, like now. Now, breaking down the different types of investing strategies, you've got fundamental, technical, quantitative. Now, fundamental is pretty much evaluates a company based on their assets, income, management, and economic moat, or the company's ability to maintain competitive advantage over its competitors to protect its long-term value over time. Now, the qualities or characteristics that they look in for a company are strong leadership, gross income track record, and solid business structure. For technical, they look to patterns and believe that the various patterns repeat, as you're kind of seeing on the left side of the screen. And they really look to analyze historical prices, and the patterns really guide their investment decisions. Now, quantitative analysis uses mathematical models to objectively determine what should be bought and sold and at which levels. They use statistics to establish correlations, and as you're seeing up on the screen here, the Black-Scholes method is probably one of the most popular methods that are being used to determine what's called the intrinsic value of a stock. And really, this is I'm actually going to be discussing this in my next video of how to find the intrinsic value of a stock or the fair market value of an individual stock. And they take more of a scientific approach to investing. Now, if you're looking at this equation and thinking like Goodwill Hunting, it's not that tricky, right? It's once you start to break down the different variables that go into the equation, it becomes a lot easier. So the key is, guys, is to be a Swiss Army knife. Take and utilize these different investment strategies and styles to incorporate into your own, day-to-day investing research, and hopefully you guys get some really great outcome from this. Now, I want to leave you with a quote that says, "If you really look closely, most overnight successes took a long time." Steve Jobs. And guys, I just want to say thanks so much for watching. And if you got some value out of this video, consider subscribing and smashing that like button. Thanks so much.